Day trading. Imagine waking up somewhere warm. The sun is shining. You make yourself a coffee, open your laptop, and spend the next few hours trading the markets. By lunchtime, you're done. The rest of the day is yours. No boss, no office, no fixed schedule, just complete freedom. It's the lifestyle you have probably seen all over social media. Luxury cars, expensive watches, exotic holidays. People claiming they make more money in a day than most people earn in a month. And honestly, it's an incredibly appealing idea. The idea of making a living from a laptop while having complete control over your time is something a lot of people dream about. But the more I researched day trading, the more questions I had. If it's possible to make this amount of money, why are so many people selling courses instead of simply trading? If success is achievable, why do so many beginners never make it? And perhaps the biggest question of all, what does it actually mean to be a successful day trader? So I decided to find out. But before looking at strategies or psychology or what separates successful traders from everyone else, I first needed to understand one thing. How do most people get into day trading in the first place? If we look at Google Trends, we can clearly see that interest in day trading exploded after 2020. That wasn't a coincidence. It was the result of a perfect storm. Pandemic lockdowns kept millions of people at home. Government stimulus checks put extra money into many people's pockets. Commission-free trading apps made it easier than ever for anyone to buy and sell in financial markets with just a few taps on their phone. And as interest grew, day trading started appearing everywhere. From YouTube and TikTok to Instagram, where creators shared winning trades, trading strategies, and the promise of making money from home. Suddenly, millions of people who had never traded before were entering the markets hoping to do the same. But the rise in popularity itself isn't actually what interested me. What I found much more interesting was what was driving that growth. When you look at the related searches, it becomes pretty obvious that these aren't experienced traders looking for advanced strategies or a better edge in the markets. Instead, the most popular searches are things like day trading beginners, day trading for beginners, trading for beginners. That tells a completely different story. This wasn't a wave of experienced traders entering the markets. It was millions of complete beginners trying to figure out where to start. People who had probably seen day trading on YouTube, TikTok or Instagram and wanted to learn more. So I thought, if I really wanted to understand the world of day trading, I should start exactly where most of these beginners did. So I opened YouTube and searched day trading for beginners. Almost instantly I was met with videos that had hundreds of thousands and sometimes even millions of views. Most of them followed a very similar formula. A simple strategy, a few winning trades, and thousands of dollars made in just a matter of minutes. It wasn't difficult to see how overwhelming this could be for someone just getting started. Every creator seemed to have a different strategy, a different system, a different indicator, and every single one claimed that their approach was the one that actually worked. If you're just getting started, it's hard to know who to trust. And after watching a few videos, I started noticing something else. Almost every creator had a link in their description. Sometimes it was a course, sometimes it was a private Discord community, sometimes it was a mentor program, trading signals, or a premium membership. Whatever it was, the message was usually the same. If you wanted to learn the strategy that made them successful, you had to pay for it. And honestly, at first, that didn't seem unreasonable. If someone had generally figured out how to be consistently profitable, then paying a few $100s to learn from them almost sounded like a bargain. Now, it's important to say that not every creator in this space does this. There are plenty of people who focus on free education or have a different business model. But after seeing the same pattern over and over again, I became curious. Not about whether these people were good traders or bad traders, but about the business behind trading education itself. So I decided to look at one of the biggest creators in the space, TJI. I wasn't trying to expose him. I wasn't trying to prove whether he was profitable. I simply wanted to understand how this industry worked. When I landed on his course page, one sentence immediately caught my attention. Become one of the top 2% of traders. The 2% who are actually profitable and beating the stock market. That made me stop. Not because I thought the claim was impossible, but because I realized I had never asked myself what it meant. What does being in the top 2% of traders actually look like? Is it simply being profitable? How much money do they actually make? And perhaps the biggest question of all, compared to what? And just like that, the direction for this video completely changed. Because before I could answer whether day trading was worth it, I first had to answer a much more important question. What does it actually mean to be a successful day trader? When I first saw the words become part of the top 2% of traders, I didn't really think much of it. Most of us have heard statistics like that before. 95 to 98% of traders lose money. Only a small group of people ever make it. So naturally, I assumed if you somehow became part of that top group, you had already made it. But the more I researched it, the more I realized that wasn't necessarily true. Because becoming profitable and becoming successful are actually two very different things. There are multiple studies suggesting that only a very small percentage of day traders consistently outperform a single investment in the S&P 500 over the long run. And if that's true, then it completely changes the way we should think about success. Because suddenly, simply making money isn't enough. If you choose trading over investing, then the real benchmark isn't whether you're profitable, it's whether you can outperform one of the simplest investing strategies available. Now, before we go any further, I think it's important to mention something. The famous statistic that 95 to 98% of traders fail is heavily debated. When I started reading discussions from experienced traders, one argument kept coming up over and over again. The barrier to entry in trading is incredibly low. Anyone can download an app, deposit a few $100s and call himself a trader within an hour. Because of that, a lot of people almost quit immediately. Some blow up an account in a week, some never properly study, some simply lose interest. So many traders argue that the success rate is much higher if you only count the people who actually try and commit for years. And honestly, I think that's a fair argument. The same thing happens in almost every difficult profession. Starting a business, building a YouTube channel, becoming an athlete. Most people give up long before they become good. So instead of arguing whether the real number is 2%, 10% or 30%, I think there's a much more interesting question. What does success actually look like? Let's assume you become one of the better retail traders. How good do you actually need to be? Of course, many people trade alongside a normal job, but the dream most people are chasing isn't earning a little extra money each month. It's making a living from trading. So that's the question I wanted to answer. To answer that, I built a simple experiment. Two people both start with $50,000. Person A decides to pursue trading as the primary way of building wealth. Their account receives no additional contributions. It grows only through their performance as a trader. Person B chooses a more traditional path. They work a completely normal job, and every month they invest $500 into the S&P 500. That's roughly 10% of a $60,000 annual salary. Nothing extraordinary, just consistent investing. After 10 years, the investor ends up with roughly $230,000. That's assuming an average annual return of 10% from the S&P 500, which is the historical average. Because the investor is also adding another $500 every single month, the trader can't just match the market's return. To reach the same final amount using only the original $50,000, the trader has to average roughly 16.5% every single year. Not one lucky year, not one incredible bull market, 10 years of consistently strong performance. Now let's raise the bar. Instead of investing in the S&P 500, let's assume the worker invests in Bitcoin instead. Now I'm not using Bitcoin's historical returns because I think that's an unfair comparison. Instead, I'm using an expected long-term annual return of around 30%, which is in line with what Michael Saylor has probably argued. Same starting capital, same monthly investment, same 10 years. Now the trader needs to average almost 35% every single year just to keep up. And that's before considering the time involved. Investing in an index fund or even buying Bitcoin can be almost entirely passive. Once you've decided on your strategy, it requires very little ongoing effort. Trading is different. It takes time to learn, time to practice, time to analyze the market, and time to execute trades. Those hours have value too. And that's when something clicked. Most people think becoming profitable is the goal, but profitability was never the real benchmark. The real benchmark is whether you can outperform someone who simply worked a normal job, invested consistently every month, and let compound growth do most of the work. That completely changed the way I thought about success and day trading. At that point, I wanted to know something else. How good is a 16.5% annual return really, or even 35% if it's Bitcoin? At first, those numbers didn't seem that unrealistic. If you have spent enough time watching day trading content online, it's easy to think successful traders consistently make hundreds of percent every year. Compared to that 16.5% or even 35% almost sounds achievable. But I wanted to know if that perception actually matched reality. I couldn't find a single study telling me what percentage of traders achieve returns like that over an entire decade. One experienced trading resource I came across made an interesting point. While day trading is often perceived as high risk, high reward strategy, realistic long-term returns are typically much lower than many aspiring traders expect. It went on to suggest that annual returns between 4% and 10% are already considered strong over the long term, while consistently earning more than 10% annually is regarded as exceptional. I wanted to know if history actually supported that claim, because it would be very easy for me to sit here and say only 0.5% of traders can do this, but I don't have evidence for that, so I'm not going to pretend I do. Instead, I decided to compare those numbers to some of the greatest investing and trading records ever documented. The first name I looked at was Warren Buffett, arguably the greatest investor of all time. Over nearly 60 years, Berkshire Hathaway compounded at roughly 20% annually. 20% for almost 6 decades. That kind of consistency is almost unheard of. Then there was Peter Lynch. During his 13 years managing the Fidelity Magellan Fund, he averaged around 29% annually. One of the greatest performances ever achieved by a mutual fund manager. Then I looked at Stanley Druckenmiller, widely regarded as one of the greatest traders of the modern era. Between 1981 and 2010, his hedge fund reportedly averaged around 30% annually. But what makes that record even more remarkable is that he didn't have a single losing year during that entire period. George Soros' quantum fund produced similar results, averaging roughly 30% annually over decades. Another record most people can only dream of matching. And then there's the Renaissance Technologies Medallion Fund, a fund that's often described as one of the greatest investment vehicles ever created. After fees, it reportedly returned close to 39% annually. A performance so extraordinary that many people consider it one of the greatest outliers in financial history. Suddenly, these numbers started to put everything into perspective. When I first built the experiment, a 16.5% annual return didn't seem that unrealistic. But after comparing it to some of the greatest investing records ever achieved, it became clear that consistently producing those returns year after year is incredibly difficult, and averaging 35% every year starts putting you in the conversation with some of the greatest investors and traders we have ever seen. Now, I'm not saying that you need to become Warren Buffett or Stanley Druckenmiller or George Soros to be considered a successful trader. What I'm saying is that when you compare trading against a realistic alternative, working a normal job, investing consistently, and allowing compound growth to do its thing, the benchmark becomes much higher than what most people imagine. Of course, these comparisons are based on assumptions. The S&P 500 won't necessarily return 10% every year. Bitcoin certainly isn't guaranteed to return 30%. No one knows what the future holds, but that's not really the point. The point is perspective. At first, becoming profitable sounds like the finish line, but once you compare trading to that alternative, you will realize that profitability was never the real benchmark. The real question becomes, how good do you actually have to be before choosing trading over investing makes sense? One thing became increasingly clear while researching day trading. You can spend months learning strategies, analyzing charts, studying risk management, trying to develop an edge, and sometimes it works. You can make a lot of money surprisingly quickly, but the opposite is also true. You can lose it just as fast. That made me wonder not whether day trading is gambling, but why so many people compare the two. Because on the surface they seem completely different. One is built around probability, discipline, and managing risk. The other is largely based on chance. So why do psychologists, researchers, and addiction specialists keep drawing parallels between them? Before going further, I think it's very important to make one thing very clear. I'm not saying day trading itself is gambling. In fact, I don't think that's true. Professional traders spend years developing strategies, testing ideas, managing risk, and making decisions based on probabilities. That's very different from walking into a casino and hoping the roulette wheel lands on red. But while the activities themselves are different, the psychology behind them can sometimes look surprisingly similar. And that's where things become interesting. The charts aren't the problem. Technical analysis isn't the problem. Risk management isn't the problem. The problem begins when emotions take control. One of the clearest examples is something traders call revenge trading. Imagine you have just taken a loss. Instead of accepting it and waiting patiently for your next setup, you immediately enter another trade. Not because your strategy tells you to, but because you want your money back. Then that trade loses too, so you increase your position size. You tell yourself the next trade is gonna have to work. At that point, you're no longer following a trading strategy. You're chasing a feeling, and the goal has quietly changed. It isn't about making good decisions anymore. It's about recovering the loss as quickly as possible. While researching this, I came across a podcast where a consistently profitable trader reviewed the performance of 20 unprofitable traders. What surprised me wasn't that he pointed out some secret strategy. It was the biggest difference wasn't technical knowledge at all. It was behavior. The losing traders repeatedly showed the same emotional patterns. Revenge trading, chasing losses, breaking their own rules, increasing risk after losing a trade. The profitable trader did something much less exciting. He stayed disciplined. He accepted losses and he continued following the exact same process regardless of whether the previous trade had won or lost. That really stood out to me because it suggests that for many traders, the battle isn't against the market, it's against themselves. That made me curious about something else. Is this becoming a bigger problem? The first place I looked was Google Trends. Searches for day trading addiction have increased dramatically over the past few years. Now, Google searches don't prove addiction itself is increasing. People search for all kinds of things, but they do tell us something. More people are asking the question, so I kept digging. That's when I found something much more interesting. According to the reporting by the Wall Street Journal, gambling treatment providers have noticed a noticeable increase in people seeking help because of excessive financial trading. One treatment center, Safe Foundation, said that today around 10% of its patients are there because of trading-related addiction. Before 2020, they had none. Another treatment provider, Williams Will Wellness, reported a 25% increase in gambling tied to financial markets compared with the previous 4 years. Meanwhile, the National Council on Problem Gambling saw enough calls related to financial trading that in 2021 it began adding questions about investing to its annual survey. None of this proves that trading itself is gambling, but it does suggest something else. For a growing number of people, the behaviors surrounding trading are starting to resemble the behaviors normally associated with gambling addiction. According to addiction counselors, one reason this often goes unnoticeable is because many people don't see themselves as gamblers. They're investing, or at least they believe they are. Modern brokerage apps have made speculative trading easier than ever before. You can open an account in minutes, deposit money instantly, receive notifications throughout the day, watch prices move second by second. Everything is designed to make trading incredibly accessible. But unlike many betting or casino apps, trading platforms often don't include the same responsible gambling tools or prominent warnings. In fact, the executive director of the National Council on Problem Gambling argued that in some cases, consumer protections in the gambling industry now exceed those in the financial markets. For someone who is already struggling to control emotional decision making, that can make it much easier to convince themselves that investing, even when their behavior increasingly resembles gambling. The more I researched this, the more I realized something. Finding a profitable strategy probably isn't the hardest part of day trading. There are thousands of strategies, thousands of indicators, thousands of opinions. The real challenge is following one strategy consistently, accepting losses without chasing them, managing risk when emotions are telling you to ignore it, and staying disciplined when every instinct is screaming at you to do the opposite. Because at the end, the market isn't really your biggest opponent. Sometimes your own psychology is. At the beginning of this video, I set out to answer one question. What does it actually take to become a successful day trader? After researching studies, watching interviews and podcasts with experienced traders, analyzing performance data, and comparing trading to investing, I don't think the answer is nearly as simple as I expected. Because when most people imagine a successful trader, they imagine someone making money. But that's only part of the story. A successful trader isn't just someone who has been profitable for a month or even a profitable year. It's someone who can consistently outperform realistic alternatives over many years while controlling their emotions in one of the most psychologically demanding environments imaginable. That's an incredibly high bar, and it's probably much higher than most people realize when they first open a trading account. That doesn't mean it's impossible. Clearly, there are traders who have done it. Some have built extraordinary careers from the markets. But after researching this industry, I don't think their greatest advantage is some indicator or some hidden strategy. It's discipline, the ability to follow a plan, accept losses, manage risk, and keep doing the same thing over and over again, even when your emotions are telling you not to. Personally, the biggest thing I have learned from making this video isn't whether day trading actually works. It's realizing that almost everyone is asking the wrong question. The internet is full of people asking what's the best strategy, which indicator should I use, how much money can I make? But after everything I've looked at, I don't think those are the most important questions. The real question is whether you can consistently execute whatever strategy you choose year after year without letting emotions take over. Because if you can't, it doesn't matter how good the strategy is. And if the answer is yes, the strategy probably isn't the hardest part anymore. So after everything I have researched, there is one thing I haven't told you yet. A few years ago, I spent around a year trying to become a day trader. I watched the videos, I believed how easy it looked, and I believed how much money people claimed you could make. In the end, I lost a lot of money. Looking back at it, I don't think my biggest mistake was losing money. It was that I never understood the benchmark. I never stopped to ask whether I could realistically become good enough to outperform simply working, investing consistently, and letting compound growth do the heavy lifting. If I had understood that from the beginning, I probably wouldn't even have started. That's why I wanted to make this video. Not to tell you that day trading doesn't work, because for some people it clearly does, but because I think very few people understand what they're actually signing up for. I know I didn't. And if this video helps even one person make a more informed decision before jumping into day trading, then it was worth making. So if you enjoyed this video, remember to like and subscribe. Comment down below what I can do better. I'd love to hear from you guys, and I'll see you in the next one. Peace.